welcome everyone for thank you for joining us on this edition of West Side Meetup. So before we get started, I'd like to go over some housekeeping rules, right? So at make sure everybody knows. So first, this meeting will be recorded, right, and posted online. So if you wanted to watch it again, if you missed it, if you missed something or want to share it with some friends, right? Second, I'd like to ask everyone to please mute your mics to minimize distractions for our speaker and for everyone else. Third, if you have any questions, please post them in the chat and we'll answer them during the Q&A portion of the presentation, right? And lastly, please, you know, stick around as we transition into breakout rooms after the presentation. And then I'd like to say that as a disclaimer, this is for informational purposes only. So do your due diligence when shopping for rates, right? And then some announcements I'd like to make is follow us on Facebook group if you're not, at Westside Real Estate Meetup Group. And you know, another thing you guys could also do is if you're not on our email list, we'd like to add you on. So please shoot us an email. Brandon will be putting that in the chat. You can just shoot us an email and we'll get you guys in there. And then lastly, small fee if any of you find value tonight in this presentation, please let a friend or family member know about us and our monthly meetup. Okay. For those of you who don't know me, quick about me is I am an out-of-state investor. Investing in the Midwest, still working a W-2, looking to grow my my real estate portfolio to, you know, hopefully increase my passive income and hopefully retire sooner rather than later. So, you know, if you're interested in out-of-state investing, let me show you how, right? And you know, I'd like to introduce my co-host here, Brandon Rabe.
Hey, what's up, Gilbert? Thank you. Thank you for that introduction. And if
Brandon, I think you're muted.
Oh. Okay.
There we go. Right on. Sorry about that, guys. Okay, thank you, Gilbert, for that introduction. If you folks don't know, my name is Brandon Rabe. I am an active out-of-state investor. I'm a real estate trainer, and I'm a co-host not only of this meetup, but with the in-person meetup that I co-host with Gilbert, Real Estate at the Park. We'll be announcing when the next one's going to be later on tonight. But anyways, thank you guys for coming. And like Gilbert said, if you guys find value from tonight, if you learned something, if it changed your perspective, please let somebody, friend or family, know about this meetup and invite them to the next one. Also, I did post everything in the chat. So if you have time, there's a roster in there. You may not be able to meet everybody on the call, but by filling out that roster, that allows you to get connected with whoever fills in that roster. All right. So tonight, I'm excited for the topic. Our real estate market and the rates and everything has been going crazy. So Gilbert and I thought it'd be timely to bring on our resident loan officer here to talk to you folks about the rates and what's going on with the market and everything else that he has to share with us. So we're going to be hearing from Mike Arrieta. He is the VP of Lending with Guaranteed Rate. His clients trust him as their mortgage consultant because he provides great service, communication, and low rates. Coming from a sales background, Mike learned he never wanted to push product on his customers to meet his goals. And I can tell you by personally working with Mike, he's a really great guy, and I did not feel any of that pressure. In 2013, Mike relocated here to Hawaii, but he also recently moved and he's up in Nevada. So actually he's a couple hours ahead of us, and we just appreciate him coming on because it is late on his end. But he just wants to give it back to the community. That's how great of a guy he is. So without further ado, I just want to bring on Mike Arrieta. to talk about the state of the rates. What's up, Mike?
What's up? Happy Wednesday, guys. How's it going? Thank you, Brandon and Gilbert, for intro and having me back on. Yep, I am a lender and active investor. Had the pleasure of knowing a lot of you guys in this room, even done business with some of you too. So awesome to always come back and connect. I was just even thinking about the UPS days, and we used to go to Heather's store. So awesome that you guys are still running this. Appreciate that. Okay, so I am going to get into a little bit of what is going on in the market today, sharing my screen, and I lost the ability to record. So I guess I don't need to worry about that. I lost the visual of your guys' faces too. So I have the chat open. I don't see any of you, so it is what it is. Just chat if you have any questions and all that good stuff. So state of the rates, West Side Meetup. I cannot take credit for that title. I love alliteration and rhyming titles, but that is either Brandon or Gilbert. So kudos to you guys for that. Yep, my name is Mike, active investor as well, lender by day. Also done a couple 1031s, and I have a duplex that I'm currently turning one of the sides on. I guess that side is notorious. We inherited a funny, a very interesting tenant, but anyway, that's in progress, getting that turned over as a hybrid burst strategy for that one. Also a commercial building we just closed on, and I'm in escrow for a quad right now. So actively investing, just like you folks, trying to get into financial freedom and controlling everything. If I make a loan, I get one paycheck, but I can turn that into cash flow for life, right, by buying property. So with you guys, I am also pursuing financial freedom. I love helping investors. I love educating investors. Sometimes traditional lending and investing doesn't necessarily like to play nice, especially with like private money. So knowing both sides, I can left brain, right brain, I can think of how to help you understand what I need to get you to close. My job is to get you to the closing table. So I am your friendly neighborhood lender, also the investor. So I'm happy to help you guys build your portfolio and get on the path toward financial freedom. All right, so just some quick notes here. This is a disclaimer. As you guys know, things change often, daily, without notice, especially in this market today. This is purely for informational purposes. This is not a commitment to lend. I have to do this every time. I might tell you something today that is gone tomorrow. It is highly probable. In fact, I had a couple of conversations, one with someone on this call. I won't out the person, but we had a call and we were going to do a second home for that person. And I was looking at the guidelines in our conversation. Oh, you could buy this place 10% down. Just looking in the resource center in our guidelines, found out that just 2 days prior to our conversation, there was no announcement anywhere, but I saw, oh shoot, now second homes require 10% down just 2 days prior to that. And I would not have known if I had not checked the guidelines. So loan officers, if you're working with a lender, make sure they're checking your guidelines. Had someone else in Texas was going to use a down payment assistance program, and we got them shopping with the program. The day they locked up into a contract, I looked up that guideline, it had discontinued the day prior. So this stuff changes rapidly, okay? Especially in this market when everything is volatile, everything's moving up. Just know this is for educational purposes. I'd love to get you guys prepared for your next move. So all that to say, let's just talk so I can be educating you on what's happening at that time, okay? So we will get into the meat and potatoes, just some quick things about who I am and what I'm doing. I'm lending in these states here. Of course, Hawaii being the main one, Kansas, state of Missouri for a lot of us that are investing on the mainland. And I'm actively going where my clients are going. So I just picked up one in Minnesota for someone PCSing out of Hawaii. So happy to help you invest in Hawaii, or if you're going to the mainland, if you want to go somewhere else, Georgia, Ohio, I've had people ask me about that. So I'm happy to go where people are going. What I'm lending. So yes, this is an investment group. I'm aware there are also realtors in this group and other people that just maybe want to buy different homes as well for stages of life. So yes, I can do primary home, second home investment, purchase, refinance, fixed ARMs. ARMs are coming back 7 to 10 years, super popular right now. Single family condo, PUDs, 2 to 4 units, mixed use can do those. Classic loans, conventional VA, USDA, FHA jumbo, bank statement loans for self-employed, we can do those as well. Some of the specialty ones, renovation loans, I love those. Vacant land, just closed on one of those for an awesome gentleman in this group. Kudos to you, shout out, you know who you are. Condo tells, debt service coverage ratio loans, we can do those as well. HELOCs, not in Hawaii, so sorry, just announce it, cannot offer it in Hawaii. Down payment assistance, although that is temporarily being phased out. What I'm not lending, I put this in here because I've had these conversations. I am a traditional mortgage lender. I am not a hard money lender. So my job, like I said, is to get you to the closing table. I'm not here for you to put your big boy pants on and learn how to negotiate, as you can tell by my demeanor. I'm just here to be a friendly. I'm not here to like nickel and dime you and get the most points out of you. I'm trying to educate based on what the market's doing. So I'm not your hard money lender. I'm not a commercial lender. We technically do have commercial loans. I've not found one that I like that I would want to market. So if down the line I might want to see something that, you know, maybe there's something that I actually like that I can refer people over to. But as of now, not something that I found a niche for that I want to do myself. So I do not offer commercial loans, is all I'm going to say as far as that goes. Business loans, I don't do business loans. I cannot help you buy out your partner in an LLC or finance your equipment directly. That's something you want to go to your business banker for. And then fix and flip loans, our stuff like renovation loans, those are not for your fix it up and flip, sell it, you know, within the same year. Our stuff would have a prepayment penalty. Okay, so this is not something that you'd want to use to fix and flip a property. So main thing, I put a house in there. Just think house. If you can live in there or you want to put a tenant in there, I can help you with that. Okay, how I'm lending, this is crucial for today. Lender for life, my job is not just to be your one transaction lender. I'm here to take care of you or your clients and be the lender in your pocket, whether you're in Hawaii or in Florida or in Kansas State or in Colorado. I'm there with my clients via Zoom, text, email, call, video messages. My job is to make them feel warm and fuzzy that me and my team are with them all the way through. And using technology like our digital mortgage, everything online, efficient 10-minute application and pre-approval, everything ease of use. So automated asset income verification, you can put that in there. We can get you shopping within 24 hours. Lock and shop, meaning, and this is a question I think Brandon might ask later on, but I'll just touch on it here. Locking your rate while you shop, because as we saw within 2 months, February to April, the rate shot almost 2.5%, right? We can protect you and your clients or you as a home buyer from trying to shop. And now all of a sudden you have a contract, the rate's up 1%. So make sure you can still qualify. Also lock and build for new construction, lock your rate up to a year and make sure that by the time your house is done, you can still afford it as well. Power bid means a live underwriter, not just a system approves you. A live underwriter allows you to offer shorter closings, even compete with cash buyers, okay? Appraisal waivers, also case by case. I just got one here in Nevada, Hawaii parents are buying property for their daughter going to college. We got an appraisal waiver, don't need to order it, cuts down the time we need to close as well. Case by case, okay? So different ways we can do closings. Flash close is like you sign some of your documents online. You have a small little stack that you sign with a notary. E-closings, all from the comfort of your home with a webcam and notary that looks at you from the webcam. They see who you are and you can sign that way as well. Traditional closings where you sign all your web docs with a mobile notary, okay? All right, all that is done. Let's get into the meat and potatoes of this. What is going on today in the market? There is a lot. So let's update the driving factors and forces between what's happening with interest rates, real estate, and recession. There is a lot to talk about. So let's get right into it. So the current marketplace, inflation is a big buzzword. Inflation is at 8% and as measured by the consumer price index, and it might peak temporarily. For now, over the summer months, we could see it come back. Inflation is the arch enemy of mortgage rates. A receiver of those mortgage payments typically is a fixed payment over time, but inflation makes it cost more, right? So the money doesn't go as far as what you're receiving. So fixed payment, but it buys less and less. The only way that you can combat higher inflation is if you're the receiver of the mortgage payments to charge a higher interest rate. So it offsets that rapid rate of erosion. So inflation is a big one. The Fed, we anticipate the Fed will still continue to hike the rates this year. Counterintuitively, it doesn't necessarily mean a bad thing for mortgage rates. We'll talk about that. So when inflation slows down because the Fed hikes the rates, it slows economic activity. So the mortgage rates respond favorably and they tend to decline. But the balance sheet the Feds have amassed, it's about $9 trillion between mortgage bonds and treasuries. And they said they would now allow to run off as they mature. So they're collecting the principal payments instead of reinvesting them back into the market, allows a portion, maybe all of the receipts that they have to run off their balance sheet and reduce their holdings. That means they're purchasing less of mortgage-backed securities. The other big buzzword is recession. So the forecast is late 22, early 23. It looks like a recession is on the horizon. So what does that mean for mortgage rates and what does it mean for housing? Okay, let's look at the Fed and do a quick recap. So going back to the 70s and 80s, Arthur Burns was the Fed chair, and he watched inflation go from 7 to 14%. So mortgage rates have to go up when inflation goes up. So they went up from 12 to 18%. So we complain about 6%, hey, 18 was what it was then. Volcker comes in and he takes the Fed funds rate from 11 to 20% within 2 years, slows the economy. So the inflation goes way down 14 to 5%. And because inflation drops, mortgage rates drop. Fed funds way up because inflation declined into a slower economy, mortgage rates dropped. So Fed funds rate up, mortgages drop. Recession, just about every time the Fed tries to slow inflation, the economy by hiking rates, we get a recession, and the stock market did not like it. Greenspan, we also saw inflation rise, and because inflation, the rate rose, mortgage rates rose as well. The Fed funds rate almost within 2%. Within a year, it slowed the economy enough to where inflation dropped. And because inflation dropped, mortgage rates dropped 8.5 to 5.5%. So hiking rates, and because he slowed the economy to kill inflation, mortgage rates decline. So the pattern is recession. It's almost unavoidable and a bad stock market performance. Jerome Powell, our homeboy today, he has seen inflation go from 1.5 to 8.5%. Mortgage rates from 2.5 to 5%. Could be 6 if you're an investor. It's most likely in the 6s with a point. So, and there's possibility to take the funds rate, which was at 0, now over 0.75%. It could get somewhere near 3% by the end of 2022. So it should cause inflation to drop. And that means mortgage rates should drop by the end of this year. So we think a recession is almost unavoidable. And of course, stock market is having a hard time. All right, so let's look at the last time we've been in this situation where the Fed was hiking rates, but had a balance sheet that they started to run off. So end of 2015, December 2015, the Fed hiked by a quarter, mortgage rates dropped. Okay, as inflation creeps back in, mortgage rates went up, and then the Fed hikes again, mortgage rates up, hikes again, and a little bit of a bump up, and the mortgage rates drop to a lower level than when before the Fed hiked the rates. Okay, so then a runoff of the Fed's balance sheet, similar to what we see today, the rates started moving up. So when they started the balance sheet runoff, they really started to rise, even though the Fed tried to hike here, the runoff and the rates, they overwhelmed it until we saw a rate hike, see a little bit of a dip. It continued to pressure higher mortgage rates a little higher. So eventually it started to take hold here. And now you have 1, 2, 3, 4, 5, 6, 7. This is eight hikes. And the Fed taking rates 2%. Finally, mortgage rates started to respond as the economy slowed. And when the Fed slowed the runoff, the economy was really slowing. And then you saw a big drop here, just cascades lower. You see a huge runoff. So very, very constructive to learn from this. We can see that mortgage rates, they're elevated now and the bright future, even though the Fed is hiking, once we get that period of Fed runoff. All right, so if you've been hearing about inversions in the yield curve, what that means is in the 10-year treasury, it's yielding a lower rate than the 2-year treasury. That's abnormal, right? Because the longer you tie up money, the bigger the risk you have, so you should have a greater reward. So this is a great indicator of recession. In the past year, we've seen a spread between the 10-year treasury minus the 2-year. It should be positive, and it does stay positive, but getting closer to April 2022, we started to see that upside down yield curve. So the 2-year was yielding higher than the 10-year, and that has a lot of people saying that there could be a recession in the wings, and we agree with that. So check this out as well. It has been pretty reliable in history. In the 70s, the 80s, 90s, every time you get that inversion, the red here, a recession follows, the white column, okay? Inverted yield, recession, inverted yield, recession, inverted yield, recession, even in 2020 for COVID. So while history may not exactly repeat itself, it tends to rhyme. So what does that mean? There are other indicators that we want to watch out for. Unemployment rate is a big one. So looking at this chart, unemployment rate is the white line, recession is the black. So every time you have a bottoming out of the employment rate where it starts to rise, historically, it has caused a recession. It's led to recession. So back to the 40s, lowest level starts to rise, recession, rise, recession, rise, recession. So 100% accuracy even to where we are today. So we could see it go a little bit lower as the Fed hikes and things slow, that employment rate could start to tick up. So as you can see, it's a really reliable forecast of recession. All right, now what does that mean if we get a recession, if we get one later this year? As far as mortgage rates are concerned, we've seen mortgage rates drop every single recession. 90s, 82, every single recession, the mortgage rates dropped, okay? So that has to mean that recessions have to be bad for real estate, right? Well, not exactly. So looking at this chart, same thing. The white line in this case, though, is the housing price index. Black column is recession. Historically, in the 60s, 70s, 80s, 90s, every time we have a recession, the prices did well, and they actually went up a little bit afterwards, even in the early 2000s. And the one anomaly everyone likes because it's recent memory is the housing bubble, where it was bound to blow up. You had subprime loans. You were doing, if you had a heartbeat and you had a name and a phone number, you were getting a loan, multiple loans. And when those rates adjusted, no one could afford their payment anymore, right? So it was overcooked. It was bound to happen. You didn't even need to have credit at the time. That's not the way it is anymore. But it actually led us into the recession. It wasn't that caused the recession, that caused home prices to decline. So found our footing and prices went up. So 8 of the 9 last recessions, the prices went up, and they continued even higher. So we believe the market today is very strong. In 2007, there was a lot of inventory, 3.7 million units for sale. Today, there's less than a million, 870,000. Okay, so today, less than 1 million units for sale, a lot less inventory. And in the meantime, with less inventory, households have grown. They are much greater than they were in 2008. So there are 14 million more households fighting for almost 3 million fewer homes. So we think we have a period of time here to contend with, but the future looks very bright. All right. Takeaways. We think the housing prices are going to continue. We think the rates could come down. So just watch what the Fed does and plan accordingly. Here's my contact info. I know we have some breakout questions that Brandon will get into, but if you'd like to connect with me, just save my information here. It is 2 R's, 1 T. I know it's kind of a nuisance. I've grown up with the 1 R, 2 T's now. Arrieta is the last name. 808-721-1071. Instagram, Mike_Arrieta. If you go to my website, it's the best way to book out a call with me. I'm the fastest by text. CJ, if you guys know CJ, he does not understand millennial thinking. If you call me, I'm like gritting inside. But texting is the way that us millennials like to respond. I will answer your call. I would love to answer your call. Sometimes I'm tied up, so I'll get to you after that. But I just might like you a little bit less unless you booked it out. So I'm just kidding. Maybe I'm not. Anyway, that's what I had for today. I will give it back to the folks and stop my share and give it back to you, Sir Brandon. Thank you, guys.
Yeah. All right. Yeah. Thank you for that, Mike. I wasn't expecting to see all the graphs and everything, so that was really helpful. And I just want to remind everybody, if you did have any questions for Mike, now's the time to post them in the chat, and Mike can take your questions. Now, since we don't have any at the moment, I know you touched on it very early on about, locking in the rates and so forth. I can't recall if you dove into it, but could you explain about how that lock rate works out? How long does it lock for and all that?
Yeah, so super pivotal in today's market. It might not be the biggest deal when you're shopping at $100,000 loan amount. Those little swings, yes, it might be $20 a month here and there. Still, it's not a bad idea. So what it actually does is we lock your rate for 90 days. So plan to maybe need to close within 30 days. So if you lock for 90, your rate is not going to go anywhere. It gives you about 60 days to shop. And then hopefully if you don't have something tied up by day 60, well, let's say you lock it up by day 60, you have 30 days to close on that before we have to get into extensions, which we don't want to be. So what I've been recommending is folks lock your rate. I've had buyers save tons of money just within the market moving. Within a couple of weeks, I had a buyer in California, he would have paid like 16 grand more in points just because the rates moved while he was shopping. So we locked him for 90. He got a home in 3 weeks and it was perfect, plenty of time. So it protects your rate, protects your pre-approval. It allows you to make sure you're not going to pay more for the house. So it does give you a time crunch in a sense, because you need to be in a contract to buy hopefully day 60 at the latest. 45 would be more comfortable. So that means you are actively putting out offers. You are looking at everything. And what I'm recommending to people, if your window's more open, lock for 90, shop for 60. You don't get anything by day 60, cancel the lock, wait 30 days because I can't relock you within 30 days without a penalty and all these extension fees on there. So wait 30 days, then lock again at market. So it's kind of a hybrid way to make sure that you're going to protect your rate and your payment, right, as you shop for homes. And there's no fee to lock unless you actually close, right, the points for a 90-day. Yes, it costs more to lock for 90 rather than 30, but it costs even more if you're not locked and the rates move up by the time you're shopping, based on what we've seen. So it's huge in this market today. So that's a typical 90-day lock. And then I see a question here from Lee, and those out of scope, but if we get into a recession, the rates dropping, and how likely is it going to affect the market rents due to macroeconomic factors like unemployment, local growth? That's a jam-packed question. I think the rents are going to continue to rise. I think it's just going to correct rates a little bit, so it might help people to buy again. But the prices, based on what we've seen historically, I don't think the prices are going to contract. There's just too much demand for little supply. So since 2008, we have not been keeping up with the demand in construction homes. So construction homes are huge. I don't know how that would affect individual markets, but I think a lot of people are moving from the coastal areas inland. So it's great for investors that are investing on inland, right? Because that's where everyone goes. It's less expensive. So hope that helps on that front.
Cool. And just to kind of follow up on the rate lock. So are you saying that if it were to expire, it's cheaper to wait the 30 days and then lock in another rate, or?
It is with, it's a calculated cost too. It kind of does depend, but you don't want to have a whole 30 days worth of lock extension fees. A couple days, I can try and get an exception on that, a week or two. Okay, you got to start considering, but sometimes stuff happens and you just pay a little bit more points, but that's less than going back to market. So, we can look. I had a client that we are doing one for, and it was actually worth it for her to pay about 3 weeks of extension fees rather than going back to the market. So yeah, I'll look at both. By that time, if you're not in contract, it's kind of case by case to see what is the market rate today and what's the forecast looking like potentially for out 30 days. So lenders, we don't know the future. We don't have crystal balls. We're trying to figure this out just like you guys are, and just seeing what's changing and trying to make the best educated guesses that we can. So it's on buyers as well, investors, to watch the market and plan accordingly, right? So yeah, I guess it's case by case on that question.
Okay. And the 90 days, so does the buyer have to close within those 90 days in order to? Okay.
Yeah, we have to fund your loan before that lock expiration, or it goes into fees, right? So if you're in Hawaii, you have to fund, wait a day, and then record. If you're anywhere else, you can fund, record on the same day. If you're this might answer your other question, but if you're investing on the mainland, you have to have time for the docs to travel back to that state, that local escrow or attorney's office. So you might sign over the weekend, gets there maybe Monday, and we fund record on that Monday. So you have to make sure you're funding by the lock expiration. So that's what we do in the back end. We monitor that, we advise and all that good stuff, and plan on that front.
Okay. Okay.
Nice. Hey, Mike. So I did have a question for you, really quick. I did go through a closing with you, and it was a pretty good experience. Very, very good customer service out there. But for those that are wanting to, start the process with you, what kind of advice would you give them? Kind of have their ducks lined up, right? So
Yeah,
if you could elaborate on that a little bit.
I think it's always worth it. Talk to a lender, not like the day before you're going to shop, even a week, 2 weeks, 3 weeks. I'll tell you what happens every time. You're going to want to buy property, and you're going to talk to the realtor like 100% of the time, and that property comes up on market, and then now offers are coming in within 24 hours, and you want to get something in, but you're not pre-approved. You got to be able to move fast. So talk to the lender early, especially if you're buying an investment loan. Okay, so gearing towards investors here, there are certain things that I would need to advise, maybe even 2 months out. If you're an experienced investor, you know what I'm saying. But even 2 months out, you might want to talk to me so I can make sure I help you get closed, a loan closed, right? So even 2 months out, yes, we might pull a credit report. We might not need to. If you have a bunch of properties, I'm going to have to look at how you file tax returns to even know. So what you think might show as qualified income and what you think your properties are doing, how they're performing, you want to buy another one, could be totally different. And the guidelines are changing. So it's always worth talk to your lender early to make sure we can get you to the closing table, and even ready to move with speed on offer that comes in. So earlier the better, all that good stuff.
Nice, thank you. And as for the BRRRR process, there's a lot of us that do the BRRRR strategy out here. How soon can you get us started with that?
Yeah, we have to wait. So if you're going to do a cash out refinance where you're actually pulling those funds back, classic BRRRR, right? We have to have you recorded by 6 months and a day from the time you took ownership of that property. So it's pretty good to start at month 4, so we can easily coast through a 60-day transaction. I mean, with refinances, and it's mostly the appraisals on those. We have to do an appraisal. Depending on the market, it could take 3 weeks. It could take 4 weeks, right? There's so many people that are now buying, especially in our market. So it's hot, and the appraisers are asking for and taking whatever. They will charge up your appraisal fee, and it's a panel that we have approved, but they still can take forever if they want to. So 3-4 weeks is typically what it takes. The earlier we start, the more time we give them, the sooner we can close by 6 months and a day. So 4 months, you've been on title. Start talking to me, make sure you have reserves in place, make sure there's no large deposits within the most recent 2 months bank statements, make sure you don't quit your job, whatever else your picture was. So even with BRRRRs, I tell people, if you're going to get into a BRRRR and you have private money on the line, talk to me before you do your cash offer. I know you're not going to use me to buy, but so I can hopefully predict, I don't know what the rates are going to be like in 4 or 6 months, but hopefully I can look at your financial picture and say, okay, good to go. Or, hey, you don't own your primary residence. I can't count that rental income. I want to make sure you can qualify. So we have to, make some changes. So you're going to get into a day one of a cash purchase, but the goal is to get that money back by 6 months, right? So always helps, plan ahead, make sure you can refi by the end of that project once you've put all that private money into that deal and you want to pull it all back. So I'm always happy to do that.
Right on. Thank you for that. And we got a couple more questions pop up in the chat. First one from Ellard. Are non-QM loans affected similarly to conventional loans?
They're the exact opposite. The short term. A conventional loan is a 30-year fixed product. Anything other than that is technically a non-traditional loan. There are certain things built into what's called a QM is qualified mortgage. So non-QM, non-qualified. That's where basically 2008 has resulted in most of these things being qualified mortgages, and non-QM are the stuff that you are you're paying a lot more for, and they require you basically to be very savvy to get it. So there's no cap to the amount of points you have to pay. There could be balloon payments on there. It's all case by case depending what you're doing. It might not be underwritten. So typically it costs more as well. So what I always think of, the easier it is to get the loan, the more expensive it is, and the harder it is to get it, the better the rate. So depending on what you're looking for, non-QM is kind of what I was mentioning before, DSCR, bank statement loans. It's all very, very nuanced. So what I could get you on one loan, I might not be able to get the other guy, depending on how financials look, how the house looks.
What about the rates on those non-QM loans? Do you know anything about that? If the rates are affected the same as conventional?
They're usually higher. So for conventional loans, we are only allowed to charge 3% for owner occupants, max, like application fees, prepaid interest, certain things that come from the lender, specifically application fees. With investors, it's 5%. So upfront, they can charge, there's no cap to the amount of points they can charge you. And I can't control it because I don't do it in-house. It's brokerage stuff, right? So those are the ones that we go different banks and we partner up with them for. So rates, just expect it to be higher because typically you're not paying on it for 30 years. It's serving a very niche purpose, and your plan is to reposition out of it, hopefully, or the cash flow or whatever your goal is gonna make it worth it.
Got it. Okay. So Lonnie asked, I think she just wanted to clarify. You did say that you don't do HELOCs in Hawaii, right?
Fortunately not. I was so excited about it and they rolled it out and cannot do Hawaii. So not yet. I can do a HELOC for a property in Vegas, but I can't give you a HELOC in Hawaii to buy in Vegas. So if you do a property other than Hawaii or Texas or New York, South Carolina, Utah, it's like a 15-day close, totally automated. It's awesome. It's a specific kind of HELOC, different than like your credit union HELOC. So if you want a HELOC on your property in Kansas State or Missouri, I could help you with that. Or Indiana. Actually, I'm not licensed in Indiana yet.
All right, cool. Rachel had a couple questions. I don't know if you see that in the chat. If you could go over each one.
Yeah, if rates drop during closing period, can we unlock for the new rate? How long are pre-approvals good for? Do you give pre-approval letters? How many loans can you? Okay, so that is, I'll try to give the most succinct answers for each. So when you lock the rate, there is a one-time, it's called a renegotiation, rate renegotiation. So within 30 days of your closing, if the rates have come down, this happened a lot in 2020. We were doing it left and right because I would lock someone 2.75 for VA. By the time we're ready to close, it's 2.25. It was crazy. So in the case of rates coming down, if you already locked, you have a one-time ability to renegotiate and go down. So that is a little bit of a protection. We have not seen rates come down where it's worth it. But yes, there is an option. How long are pre-approvals good for? With an asterisk, I will say definitively they're good for 90 days, but technically, if you're not locked, it's just a piece of paper. Okay. Pre-approvals, they give you the ticket to buy a house. It tells the listing agent and the seller that I've looked at your information, fully vetted you out and scrubbed your credit, all that good stuff. I can lend this much money. So just know that it's not a Bible, right? If you change your income, if you add more debt, if you don't tell your loan officer what you're doing, then they are going to have to try and catch up and figure out how to keep you pre-approved. Main thing is locking. That's the biggest part today. You could be pre-approved at 4.5%. You lock it up, a contract, a month later, now it's 5.5. So I would say everyone that's shopping in today's market, if you have a pre-approval letter, make sure it's a locked rate. Otherwise, it's meaningless because the rates as of yesterday are gone. They are meaningless. So I don't just give pre-approval letters. Yes, I do give pre-approval letters. That's how we get people shopping. But that's after I've, like I said, scrubbed your income, got an application, got credit, and I am telling a listing agent, you are good to go. In fact, I'm wanting to do higher than a pre-approval letter today because there's so much competition. I want you approved with a live underwriter. So it tells them you're 100% guaranteed to close. Just got to put a house in there. How many loans can you do per one person? It is 4, and I think it maxes at 1.5 million. I could be wrong. That's the last time I checked. You can technically do more if it's like a bunch of $100,000 ones, but the reserve requirements get higher for each one. So once you get to like 7 to 8 to 10 properties, the reserves are like 8 months for each. So it jumps. So yeah, technically it's, I guess, 10 is the max per se, but there's some asterisks in there. I didn't even know CJ was here. 8 to 12 months. What is that question for? What is that answer for? Hi.
That was what we were told reserves.
Okay,
when we
cool.
when we hit the 7 door mark.
Thank you. See, you remembered my presentation better than I did. That's why he's the man.
So with the doing multiple loans at the same time, when the underwriter is looking at your financials, are they factoring in all the other loans that are going on, or are they just looking at that one specific loan?
Okay. I would say as a loan officer trying to make it smooth and warm and fuzzy for every client, my advice is do one loan at a time. If that happens, just know it has to match, and they do soft credit pulls at the end to make sure once you change something on the other end, I have to update it on the other end. So I have done 2 loans for someone simultaneously, but it's your job as the borrower to make it as easy as possible for your lender and your underwriter and the processors to do their job. So the rule of thumb is do one at a time. If it's a traditional loan, if it's a commercial, I would have no idea. They don't even pull credit. So residential, rule of thumb, do one. Otherwise, make sure you are upfront with your loan officer about everything, because you can get to the closing table and something you did weeks back, you never told them. Now it comes up, we have to figure out how to get you closed. So just keep that in mind.
Cool.
I caught something there. You said they do soft pulls right before we close. Is that so there's a hard pull in the beginning?
Yeah. So yeah, checking for any new
Why is that? Just verification?
Yeah, verification, any new debts, anything that has any surprises, right? So I always tell clients, until you have keys in hand, do not touch your credit. Don't buy the Ferrari. Don't go buy a Tesla. Don't buy furniture until you have keys in hand. Then you can go and buy all that stuff. But until you get keys in hand, make it very simple for your lender, because they have an application built on certain numbers, income and debt, and their job is to fixate that as much as possible so the underwriter can validate it and give you a loan based on those parameters. So once that changes, everything else changes. So make it as simple for them to do their job.
All right. I don't believe, well, Gilbert might have touched on this question, but it was a question that I had earlier, right? About many people in the group are out-of-state investors or looking to get started in investing out of state. And you mentioned that you do lend in multiple states. So could you kind of just briefly go over what that closing process would look like for them if they're living in Hawaii or living in another state and they're buying in another state, because this might be their very first time, doing something like this?
I would say the easiest way to do it, just know that Hawaii's closing timeline takes the longest. Okay, so Hawaii, if you're buying in Hawaii, day 1, you sign. Day 2, you bring your funds in and we fund the loan. Day 3, we go to the beach. We don't do anything. Okay, day 4, you record, you get keys. So it's a 4-day process to close in Hawaii. Most of the states, you have a 2-day closing, you sign, and then day 2, you fund, record. Okay, and then I'll go back to revisit that. In some states, you can sign, fund, record all in one day. Just had a buyer in Texas do that. Now, the trouble is, if you are doing most closings, if you're in Hawaii and you're buying, I'm just going to say Florida, because that just happened. It's going to take time because you have to sign the documents, and most attorneys, escrows, they want those original documents back before they will close and record on your loan. We can close with just copies, but I've yet to see an escrow company that would allow us to close without the original. So you're probably going to have to plan. And we have some UPS guys in here that might know better, but typically 2 days. They say overnight, and it takes 3 days. It depends on the time it gets from FedEx into the like 11 a.m. typically. So just know, if you're closing from something in the mainland, just think, and we plan this out, accordingly, but you're going to sign with a notary, and then the notary is going to take those papers, make sure you wire your funds. They're going to get it to FedEx. It's going to get 2-3 days back to Kansas City, and then they will fund record the same day. So that's typically the easiest way to do it. We have e-closings, but that depends on the escrow office if they are willing to do it. So yeah, 2 to 3 days is your rule of thumb. The main thing is your funds are in. So always wire your funds the day you sign, if not the day before. Do it right after, so that by the time the docs get there, your funds are there waiting to.
So you're saying it's the title company that determines whether they need the originals or you can e-sign? It's not the lender?
Title company, yeah. I mean, we can get them in our system to do e-closings. We just rolled out e-closings last 6 months, maybe. So we're still trying to get more and more companies into that. It's really just like 10 minutes for them to get on this electronic portal. But yeah, it's basically the notary is there on a webcam with you. So it helps when you have like, a VA guy out on active duty and the spouse is back home, have them both on webcam, a notary sees them both, they sign docs, send it all back. So that's just going to be case by case. So generally just think you're going to sign in your living room or at Starbucks with a notary, have your ID present, and just sign the same way all the way through on those closing documents, keep it the same signature, and they'll use that, put it back in the FedEx envelope and send it back out.
Oh, okay. I thought maybe it was dependent on the product you're getting, like if you're getting a mortgage compared to a HELOC, but sounds like it's just depending on the title company.
Yeah, it's
Okay.
the same.
Okay. All right. Cool. Okay. So we're coming up close to the hour. Does anybody have any other questions for Mike? Because it is getting late on his end. We don't want to keep him here too long. Escrow companies vary in the closing process. Okay. Thank you for that, CJ. All right. Well, did you have anything else to share, Mike, before we get into our next segment, going into breakout rooms?
No, I think it's just, I love being with investors, networking with investors. You guys are fighting the power, man. So go tell everyone else to partner with you and learn how you do it, and then help them see the opportunity, especially in today. I'll say, especially in today, this might be a spoiler for the breakout rooms, but just buy real estate, man. Stock market, Bitcoin, everything's down. Real estate is up, rents are up. Yes, rates are up, but it moves with the tide. So just buy real estate.
Definitely. All right, cool. And you guys, Mike had a lot of good graphs up earlier. If you wanted to catch it again, we're going to post it in our Facebook group and on YouTube. And if you missed getting Mike's contact info, I'm going to throw it in the chat. But I think Mike said your email address is the best place, and then texting you, right?
Yeah, I'll probably get back to you within a couple minutes for a text. Email, I'm always checking as well. So those are the fastest ways. Thank you, Brandon, for posting that.
All righty. And I can tell, I'll testify that Mike is very, very good in communication. I'll text him random questions and he'll get right back to me. And if he doesn't know, he'll let me know that he'll figure it out. So thank you for that. Just don't spam him. Like you said, respect his time and all that.